Okay, so chapter 9, as it says here, is responsibility, accounting, and decentralization. Basically, we're learning how do we help keep track of how each manager is doing, right? Because every manager gets evaluated on the performance of their department or their work group. And so they need to know what that performance is, right? And accounting plays an important role of that because we track the costs, the sales, profits, and so on. And that helps to evaluate. Some organizations are more centralized, some are more decentralized. So we'll look at how that impacts the evaluation of the performance as well. Right. So again, the difference between centralized and decentralized management, especially how that impacts us from an accounting standpoint. We'll look at decision-making within organizations, again, sometimes more centralized, sometimes decentralized. We'll learn about the different types of responsibility centers. Has that phrase come up before, responsibility center? No? Okay. Well, we'll learn what that is and the different types. And the effects of various decisions on performance evaluation. For example, sometimes companies allocate costs to different departments and say, these are your costs, when the manager has no control over those costs. So we'll look at those sorts of situations and how fair that might or might not be in evaluating that manager. So overall, you know that organizations are systems, right? I talked about that in the first week of class. You can look at a corporation as a system. You can look at any business as a system. And a system takes whatever inputs and turns them into outputs, right? That's what every organization does. Well, within organizations, you need systems as well. You need information systems, you need security systems, and you need management systems, a way to manage your managers and make sure they're doing what they're supposed to do. So here it talks about a management control system. And again, accounting plays an important role here. Because what are managers evaluated on? Mostly revenue, costs, and profit, which is a difference between your revenue and your costs, right? So it would be hard to evaluate managers without that crucial information that comes from accounting. So here's an example. You might be familiar with Procter & Gamble. They're one of the biggest consumer products companies. If you go to CVS or any drugstore, you're going to see a lot of Procter & Gamble products there under different brand names. But if you look closely somewhere, it'll probably say Procter & Gamble. So you can see, here it's got 10 different product lines. Baby products, family products, whatever that is. I'm not sure what a family product is. Home products, grooming, etc. Now, in a large company like that, that's got so many different product lines, that raises the question, how centralized versus decentralized should their decision-making, their management, and just their overall approach to business be? Obviously, you've got the parent company, Procter & Gamble, with multiple brands and all these different product lines. So it would probably make sense to put somebody in charge of each of these product lines, right? Somebody in charge of the feminine products, somebody in charge of the fabric, etc. And under them, they probably have multiple departments with people in charge of that. So by doing that, you've kind of decentralized, even though ultimately parent company and whoever's the CEO is at the top of the pyramid. They've given a lot of power and decision-making, ability to people below them. They spread that out throughout the organization. In a large organization, if the person at the top insists on controlling everything, it's not going to work because they can't know everything that's going on, right? They can't be at every meeting. They can't understand every product and every type of consumer. They have to delegate that work. So the question becomes, how much do you delegate and how much do you keep things centralized? In this organizational chart that we see here, this company has a president, okay? That president oversees these different functional areas. So they probably have a vice president in charge of sales and marketing, vice president of operations. And so you've got these 4 departments whose leaders report directly to the president. That's fairly normal. But notice that they've done something else here. They've also set up these 3 geographic regions. And so you've got somebody in charge of each region as well. Maybe they're doing, I don't know what they're doing in those regions. Because we already have sales and marketing, operations, manufacturing, and finance. Maybe they're running the local branch office and satellite offices. But then it gets a little complicated because if you're in the Northeast region and you've got a sales and marketing issue, do you decide that? Or do you have to go to the sales and marketing department? If you're in the Southwest region and you have a finance issue, how much decision-making control do you have? Can you solve it? Or do you need to go to the finance department? So it has to be clear who's responsible for what. In an organization that's more centralized and they keep the decision-making among a smaller group of people, what do you think would be the benefit to that centralization? What's the positive aspect of keeping control and decisions managed centrally? Well, let's take a personal example. Think about a household. You've got parents, let's say, several kids. Who tends to make the decisions in a household? Mom. Yeah, well, okay. It kind of depends on the dynamics of the household, but the parents more so than the kids, right? Especially when they're young kids. As they get older, some of that decision-making ability that the parents have, they then start to delegate to the kids and let them make some decisions about like what they're going to do in their free time, what classes they're going to take, right? You don't get to decide that when you're in first grade, but maybe when you're in college, you do. So in a family with small kids, you have very centralized decision-making. And then in a family with older kids, it's more decentralized, right? So when it is centralized, what's the advantage to that? Okay, more control? Yeah, the parents get to decide. They have control. There's less communication that's needed because there are only probably 2 people making the decision, right? And maybe 1 or maybe 2, usually not more than 2 parents in a household. So that's not a lot that they have to communicate. Once the kids are older, then you maybe start to have big family talks and everybody's involved, and it takes more time for discussion. So yeah, it's more efficient. You have more, it's more clear who's in control. but there are downsides, right? What are the limits? Especially once the kids get older, what are the limits to keeping decision-making centralized?
Not as flexible.
Yeah, sure, it's not as flexible. You don't get the input of other parties. Were you say something?
Oh, no.
Saw your arm move. Yeah. As kids mature, they could provide valuable input to the decisions. I mean, my kids give me feedback all the time. And a lot of times, they have a different perspective that I find valuable. So we have to apply the same concepts here in organizations. When you can keep things centralized, it's easier, it's more efficient, but you miss out on some of the benefits that come from decentralizing, where you get other perspectives. And not as much work for the people at the center if they've given some power and decision-making to the other parties. So here's a more decentralized organization. Now notice we've got in every region a sales and marketing department and a manufacturing department. Instead of, in the centralized example, we really just had one sales and marketing department, right? And one manufacturing department. Okay, so now sales and marketing here, all they have to worry about is the Northeast region. So they're able to provide more customized services and more focused services just to that region. Same thing with manufacturing. They only have to worry about what their region needs. Obviously, that focus is a good thing, but there's a downside here as well. You decentralize what in this way, what then is the problem? One of the problems that might arise. Compared to this previous example with one sales and marketing department, one manufacturing department, you've got three of each. You think you might have some consistency issues where one's doing things one way, one's doing things another way. They might compete with each other instead of cooperating with each other. Right? So you have to then manage those processes. How do you get them to work together and share some resources, share ideas? We run into that thing right here at Hartnell, right? There's some things that, for example, each dean gets to decide for their department, or each faculty member gets to decide for their class. And there are other things where we don't have any choice. Decisions made by the union, or HR, or the president. So every organization has to make this decision. What do we centralize? What do we decentralize? Any questions or comments on that concept? Okay, so let's look at some of the types of decisions companies have to make. Their purchases, especially the big purchases. Those are important decisions. Personnel, who they're going to hire, who they're going to fire. If they have to lay people off. What products and services they're going to offer, what price to charge, where to sell their product or service. These are all really important decisions. And then let's apply this concept of centralization, decentralization, or combination of the two to these three types of companies. Starting with an auto manufacturer. Now consider they have to make all these different kinds of decisions, right? So let's say you're Ford. Trucks, cars, SUVs, who knows what else. And so you've got multiple production departments, right? Ford plants in different parts of the country. Obviously, the manufacturing is decentralized, happening in multiple places. Are there some aspects of Ford that you think they probably decentralized?
Like corporate offices?
Okay, they probably have some corporate offices. And what kinds of things you typically do at the corporate offices? Hmm? HR, yeah, that makes sense, right? You often have a centralized HR department. You could decentralize HR, but it's a very common thing to keep centralized. Well, what else tends to be at corporate? Finance, accounting, right? Maybe marketing. Because these are things that can serve the entire company. The actual production of the vehicles, well, again, that's happening at the plants, so that's decentralized. But a lot of what they call shared services will happen at corporate, which really is a lot of those period costs, right? Administrative and the selling sorts of things. That's often what happens at corporate, whereas the production and the direct actual salespeople are typically spread around geographically and decentralized. What about a small florist shop with 3 part-time employees? You think that would be more centralized or decentralized? Centralized, exactly. You're not going to give a lot of decision-making authority typically to your part-time employees, unless they've been there for many years and you really trust them. For the most part, the couple that owns this floral shop is going to make the decisions, and the workers will just do the work. What about a law firm with 4 attorneys? What do you think? How centralized or decentralized would that be? A question. It could be if the attorneys are really working on the same cases together. Yes. But if they're working on separate cases, then they need a lot of freedom to do their own thing, right? So it kind of depends. I could see that going either way. So again, when we're thinking about these companies and how they delegate authority and decision-making, well, people have to be held accountable, right? If you've got a manager who's not doing a good job, their costs are too high, their revenues are always low, you want to know that, right? And then either figure out how to get their profits up or let them go, right? So again, we have to come in as accountants and keep track of that. So that leads us to responsibility accounting and responsibility centers. All we're doing is saying, let's figure out what each manager is responsible for so we can track that, provide reports that show how they're doing, and that'll help their boss decide if they're doing a good job. So these responsibility centers come in these different varieties. You have a cost center where all the manager can really be held accountable for is the costs. Let's think about a department like that. We talked about human resources earlier, right? Human resources can control costs, like how many people work in the HR department, how much they spend on equipment, on different services that they have to purchase. Every department to some degree can control its costs. But they don't generate revenue, right? That's not the job of HR. Who generates revenue for a company? Sales, marketing, right? So HR would fall into a cost center. that's what they would be held accountable for. I mean, you could also hold them accountable for more qualitative things like, are they doing a good job of keeping employee turnover down? Can't really measure that financially, but we're focusing on the financial things here, like cost. Then you've got discretionary cost centers. There are some cost centers where certain costs are allocated to them. That, okay, there are some costs that you can control. There are other costs we're just going to assign to your department. Oftentimes those are fixed costs that they don't have any control over. So discretionary cost centers, just a variation on a cost center. Then we've got revenue centers. Now, a revenue center does have costs, but they're considered insignificant because the main job of this revenue center is to bring in revenue. Like Miranda said, that would be sales, marketing. You could think about a telemarketing department, for example, a department that just takes reservations. All they're doing, or the main thing that they're doing, is driving revenue, right? So that's the main thing that they would be evaluated on. As long as they're bringing in that revenue, their costs are probably not a big deal. But then we've got profit centers. What do you think a profit center would be evaluated on? Profits. And how do we calculate profits?
Revenue minus cost.
Revenue minus your costs, right? So they're being evaluated on both, how much money they're bringing in and how much money they're spending. And then we have investment centers. Some of you mentioned that phrase earlier. What is an investment center? How does that differ from a profit center? Right? So an investment center is a profit center that can invest the company's assets. They're allowed to say, we're going to take some of the money here from the company and we're going to expand our operations. So if you're given that authority, you're held responsible not only for what profit did you make, but did you get us a good return on that investment? Okay, so these are the different responsibility centers. Any questions or comments? All right then. So we have here a custodial department. They don't drive revenue, right? All they do is, well, all they can be held accountable for is their costs. And are they doing a good job, right? But that's a different thing. From a financial perspective, we can only hold them responsible for their costs. So let's take a look at this custodial department and see how they're doing. Okay. Boy, work, that's better. Okay. We see here their budget and their actual costs. In this column, we see the difference, and then we see the difference as a percentage. Now, you might have heard the phrase the bottom line. In business, people talk about the bottom line, right? What they mean is the bottom of these statements or these reports, because that's where the totals usually are. And in fact, the bottom right is generally where you want to look first if you want to get a clear picture of what's going on quickly. If we look in that bottom right corner, we see their costs were 5.2% higher than the budget. Okay. You don't want to have your costs be over budget typically. So that might be an issue. 5%, maybe it's not that bad, but it is definitely something to work at, to look at. So if we want to dig a little deeper and try to figure out why are the costs over budget, Well, look at this. Cleaning equipment, we're 260% over budget. As a percentage, that's very high, right? Now, if we look at the dollar amounts, we see, oh, well, it was supposed to be 125. It was 450, so we were $325 over budget. Yeah, that's a large percentage, but it's not a lot of money. But yeah, it's worth looking at and trying to figure out what happened there. But it's not really making a big contribution to this 5%. We see this one also small dollar amount, even though it's a large percentage. Here's the biggest dollar amount, even though it's only 3.3%, it's a $500 difference. And that's the wages. Maybe we had some overtime. Maybe we added more staff. So this allows us to see pretty quickly, how did this department do in terms of controlling their costs for this period of time? You see how the percentage is useful, but the dollar amount is also useful. All right. Does anyone have questions or comments? So I already talked about that. Let's look at a profit center. I'll make this one a little bigger as well. Again, profit centers are evaluated both on their costs and on their revenue, right? So again, let's start with the percentages. We see they were 13.5% over budget. When we're talking about profits or revenues, that's good, right? You want to be over budget in terms of your profit or your revenue, and under budget in terms of your costs. If you guys want to chat outside, feel free. You don't have to be in here. I won't take it personal, but try not to disrupt people around you. So 13.5%, that's pretty good, right? And in fact, that's $3,891 over budget in terms of our profit. That's great. So let's see what led to that. This is the children's clothing department of a department store. So when we look at the revenues, we see we've got clothing revenue and clothing accessories revenue. Which one did better? Yeah, it's clear, right? We can see they were 20.7% over budget, whereas with clothing accessories, way under budget. For some reason, we're not selling accessories very well. Maybe we had a sale on clothing and didn't have a sale on the accessories. I don't know. Let's look at the expenses. We can see, here's a large percentage difference, but again, relatively small dollar amounts. Here we've got a large dollar amount, right? The cost of clothing sold was $24,000 over budget, which was about 28% over budget. Is that okay? What do you think? Considering how much revenue was generated by clothing? Are the costs appropriate? If we look again and see we were 21% over budget in terms of clothing revenue and 28% in terms of clothing costs, well, that seems a little out of whack, right? Yeah, we sold more clothing, but why did our costs go up as a larger percentage compared to the overall revenue increase, right? You would think if our revenue went up 21%, our costs would go up 21%, not 28%. So that might be worth investigating to see what's going on there. And you're not only looking for, what went wrong, we're also looking for what went right. Like, why was our clothing revenue so high? Because if we understand that, maybe we can repeat it next month or year, or whatever this is, next month. Right? So this is a great tool, not only for the manager of the department, so they can evaluate their own performance, but for their boss, right, to evaluate their performance. Any questions or comments? All right, well, let's go ahead to the next slide. Oh, that was the children's clothing department. This is the women's clothing department. Okay, let's see how they did. How'd they do on revenue? Pretty good, yeah. Over budget in both areas, right? They brought in $95,000 more than the budget. Not bad in 1 month. How about expenses? What jumps out to you here?
Cost of clothing stores.
What was that, Miranda? This 43.2%, is that what you said? Yeah. Okay, yeah, that is a high percentage cost of clothing sold. So yeah, compared to, they were 30% high on clothing revenue, but 43%. So similar to the children's clothing, right? Why are the costs so high? Well, maybe they're bringing in premium, new fashions or something that's costing extra, and that's why they're selling so well. Perhaps, but that's eating at our profit margins, right? If your costs go up faster than your revenue, your profit's going down. Now, overall, their profit was over the expectations, 4.3% over budget. So what else is going on here when you look at the costs? Other than the cost of the clothing, what were their other big cost areas? You look at the accessories, the revenue went up 20.8%. Cost of the accessories went up 20.8%. Okay, well, that is correlated. That makes sense. Okay? Associate wages, 9% over budget. Okay, that might be an issue. Why? Especially because it's a pretty good dollar amount there, $3,500. Why are we spending so much, right? Is it overtime? Is it, people standing around that we don't really need? Or is it just because we've been so busy, we actually needed that much staff, and maybe we need to adjust our budget? Anything else interesting here? Oh, let's think about, where did these percentages come from? So obviously, if you take your actual and you subtract your budget, you get the difference, right? As a dollar amount. How do you get the difference as a percentage?
Divide your difference from your budget.
Exactly. You take the difference amount, divide it by the budget, and that's where you get the percentage. So when we do that down here, this 2,533 extra dollars of profit that we got, divided by the budgeted profit, tells us we were 4.3% over budget on profit. Okay. We talked about investment centers already. I didn't really get into some of these uses of these investments. I said that investments could be used to expand your business, but that could include things like improve the value of the business by improving customer experience, increasing customer loyalty, anything that you do that makes the organization more valuable. And you're using company resources to do it would be an investment. So let's see, we're back to the children's clothing department. If we compare actual to budget, now this is interesting. If we take their profit, or in this case, the budgeted profit, and we divide it by their total revenue, we get 19.5%. And what's interesting here is their actual profit was about $4,000 more than the budget. That's a good thing. But their profit margin percentage was lower than the budget. And again, that profit margin percentage is your profit divided by your revenue. So why is it that even though their profit went up, their profit margin percentage went down? Tell me how that's mathematically possible. What's going on there? We're more profitable, but as a percentage of our revenue, less profitable than we're supposed to be. Got it, Alexis? Okay, what you got? Yeah. An extra $4,000. Oh, you mean because of the extra money that we made? And so then, how does that give us a lower profit margin percentage? This is a little bit of a riddle.
Is it because our expenses were more than we budgeted for?
It's the expenses. Yeah, it's the expenses. See, our revenue went up. Well, we don't see the percentages here, but it went up $4,000. What would that be out of 28,000?
1/7, a quarter.
What is it?
4 out of 28, you said?
Yeah,
Yeah, it's 1/7.
it's what?
1/7, it's 14.
Oh, 1/7. Okay, 1/7. Okay, which would be
14%.
14%. Okay, so our profit went up about 14%. How much did our expenses go up? So about $25,000. So that'd be about 20%, something like that. You got the calculator there, so relying on me, Robert.
Yeah, 21%.
21%. That's what happens. Our profits went up 14%, but our expenses went up 21%, right? So our profit as a percentage of our revenue actually went down, even though as a dollar amount, it was going up. So yeah, it's a good thing that our profit went up, but it could have gone up a lot more if we had kept our costs in line, right? Well, let's see, where's the big one? Here's the big one. The cost of clothing, again, that seems to be the culprit. Went up $24,000 or so. That really ate into our profits. So if we could have kept that down, not only would our profit have been higher, our profit margin percentage would have been better. So that's why we have this profit margin percentage. Tells us how profitable are we in relation to how much we sold. Any questions or comments? All right. And I got to see what's going on here. Oh yeah, so this is just what we saw before. Remember, we were 4.3% over budget in the women's clothing department. And our profit margin percentage was 18.2%. So those are telling us different things. This is comparing our actual, well, actually the difference with the budget. Right. In other words, we were 4.3% more profitable than we had budgeted. And this is a vertical comparison, right? Here, what we're doing is we're comparing our profit versus our revenue. So they're telling us two different things. All right, any questions or comments? In financial accounting, you probably learned about return on investment. So this might be somewhat familiar. It's a very common ratio that investors will want when they're investing anything. If they're investing in stock, if they're investing company resources, if you're buying a house, return on investment works in all those different scenarios. Anytime you're making an investment and then hoping to get something back, you can then evaluate what you got back with what you invested, and that's your return on your investment. So it's a very simple calculation. The return has many names. It could be profit, it could be net income, it could be operating income. Any sort of profit is your return. In this case, they're saying segment profit. So it's for one segment of the business, how much profit did they make? But like I said, it could be any profit, and then you divide it by whatever you invested. And that's your return on investment. You buy lottery ticket, or I don't know, how much does a lottery ticket cost? $2? $2?
Yeah, $2.
Okay. Say you spend $2 and you get zero back. You get a 0% return on your investment, right? You spend $2 and you get $4 back. Okay, well, in that case, you would take 4, your profit. Actually, your profit would be 2, right? You would take 2 and divide by 2. Made 100% return on your investment. Put in $2 and you got back that much in profit. So it's a pretty simple calculation. Just keep in mind, just like the return could be any type of profit, the investment could be any type of investment. You could invest money, you could invest other assets. We're going to see some problems where it just says the amount of assets that were invested. Okay, so that's all you have to do with return on investment. The higher the result, the better. In general, in the business world, if you can get a 10% investment on something, that's pretty good. Depends on what industry, in some cases you can get higher returns. Some cases it's lower. Like you think, let's say Walmart is going to open up a new Walmart store. They might make a couple % a year in profit on that store after they cover all their costs. Very low profit margin. But when you've got hundreds of thousands of stores, right, it all adds up and makes a lot of profit. You could measure ROI for every department. For example, if we look at that children's clothing department, we take their profit, divide by whatever assets were invested to get that profit. And this is not the costs, right? The costs were already factored into the profit. These are other assets that the company invested. Maybe they had to buy some special equipment or pay for some other company to manage some of their services. So this is over and above your normal expenses. So you take the profit, divide by the investment, and hey, the children's clothing department has a 25.9% return on investment. Pretty good. Now the women's clothing department has only 3.9%. The profits were not that different. What's different, apparently $65,000 was invested to get that 2,533 bucks. That's not that great of an investment, right? You have to invest $65,000 and you're only getting back 3.9% a year. When are you gonna really fully get your investment back? It'll take a long time. Now, this is interesting. I'm sure you've heard of this company, Microsoft. They're based up in Washington. They are one of the best investments anybody could have made since 1926. Now, Microsoft has not been around since 1926, but even if you go back to 1926, you're not going to find companies that have provided a better return on your investment. If you'd bought their stock in 1986, you would have made an average of 25% per year. That's an incredible return on investment. Normally, if you get 10% in the stock market, that's pretty good. 25% over 40 years, and you're getting that every year. That means your money's basically doubling every 3 years because that compounds. If you're taking whatever you earned and you're reinvesting it in more stock, it's compounding. And you might think, well, 25% for 1 year, multiply that by 3 years, that's only 75%. No, with the compounding, you're already up to 100%. So every 3 years, you're doubling. And people who did that, who bought Microsoft stock back then, they put in $1,000, they're sitting on a huge pile of cash if they cashed it out at some point. On the other hand, Sears, you heard of them? They were really the first mail order company. Back more than 100 years ago, they would mail catalogs out to people. People would order things through the mail and they would get delivered. You could even buy a house through Sears. They would send you all the pieces and then you assemble the house. And then they had stores all over the country. And for a while, they were hugely successful. And not so much anymore. Not doing too well, right? They had their own trouble. They thought maybe combining with Kmart was the solution. I don't think that really helped. Probably made things worse. So if you'd invested in Sears, it probably would not have turned out as well, right, as investing in Microsoft. So this is where knowing the return on investment is useful information for an investor, right? And we never know, right? When you make the investment, you don't know what the return's going to be. So how do you figure out what's a good investment before you invest? What would you do if you were going to buy some stock in a company? How would you research the company? Financial statements? Is that what you said? What it sounded like you said, yeah. It's a good place to start. Look at their ratios. Understand the history of the company. What their direction is. Look at their competitors in their industry. Pay attention to who the executives are. If you're Warren Buffett, who's probably one of the best investors ever, you actually go visit the company, understand how they really work, how they really make their money, and if it's really a sustainable business or if it's just something that looks good on paper. So these ratios would be really helpful. So we talked about return on investment. And here's another one you might remember from financial accounting, residual income. Return on investment was a percentage, right? Take your return, you divide it by the investment, and it gives you a percentage. But residual income is a dollar amount. You take your profit or your income and then subtract what you invested times the annual cost of that investment. So the answer it gives you is a dollar amount. Here's an example. This company is thinking of buying $1 million machine that will generate $130,000 of profit per year. Now, for them to finance buying the machine, whether they're using equity finance or debt financing, either way, it's going to cost them 12%. That's the number that they came up with, their cost of capital. So in other words, if they're going to make this capital purchase of this equipment, you're either going to have to borrow money, they're going to have to sell some stock, and the cost of that is going to be 12%. Then what we do is take the annual profit of the machine, that's the extra profit we're going to make because of this machine, subtract the $1 million cost of the machine times that annual cost of capital. And it doesn't tell us what that comes out to, but 1 million times 12% is going to be 120,000, right? Oh yeah, it is. The answer is right there. So if you take $130,000 annual profit times the $120,000 annual cost of capital, you get a $10,000 residual income. Residual just meaning leftover. So that is the profit you've made after the cost of the capital. And as long as it's a positive number, it's okay. If it's a negative number, you probably don't want to make that investment. Because even though you're making a profit, the cost of the capital is eating up that profit. Okay, so that's how you calculate residual income. Questions or comments? All right, ooh, a sample problem. Great, we can work on this. So problem number 3. Let me go ahead and open it up in the problem set. I think it'll be a little easier to follow along. All right, let me walk you through this one and then you can do the calculations. So the first thing we have to do is figure out operating income as a dollar and a percentage for the year. I'll tell you what, I'll do the first column and you'll on your own do the second column or together in groups. So operating income, who can tell me how would we calculate our operating income if this is our income statement? The little ladder? Did you say gross? Yep, gross profit minus the total expenses. Very good, so let's do that. Okay, we have gross profit. Now, it says that these amounts are in thousands, but we're going to keep our answers in thousands as well, just to keep it simple. So gross profit minus expenses, operating income is $1,687, which is really $1,687,000. Then how do we figure out the operating income percentage? Earlier, we saw the profit margin percentage. This is the same concept. How do we turn this operating income into a percentage? What do you think? What we're going to, yes, go ahead, Jaira.
Do you divide operating income to the total?
Good guess, but not quite. We do divide our operating income, but by our total revenue, which is our sales. Okay, so we take operating income, divide by sales, and we'll just call it 5%. We'll round it off. Okay, since it says percentage over here, I'll just put 5, but remember in Canvas, you'd have to put it in as 0.05. Okay. Then return on investment. What was the formula for that?
Is a segment profit divided by the investment base.
Okay. So right here, it tells us our investment base. There were $4,500 of assets we invested. Doesn't really tell us what they were, but that's okay. And we don't have a segment profit. So what do you think we might be using here as our return? Which one?
Gross profit.
It's not gross profit. It's the operating income, which is kind of like net income, right? The bottom line. So we're taking operating income divided by the assets. And our return on investment, I think we'll just call it 37%. Yeah. And then residual income. What was the formula for that?
Income as investment times cost of capital percentage.
Yes, exactly. So we take our income, which again is going to be the operating income. Then we subtract the investment times the cost of capital. And it tells us down here we have an 8% cost of capital. So we have to start with the investment times the cost of capital. And that comes out to $360. Then we subtract that from our operating income. And we get our residual income, $1,321. So that is how much profit we have after that cost of capital. Any questions on these calculations for the current year? Okay, so go ahead, work on the prior year. Give you a couple minutes to do that, and then we'll check your answers. Okay. So we're not done. Let's go on to the next part. Was the decision to invest additional assets in the company successful? So in the prior year, they had invested $1,500, but in the current year, they upped that to $4,500, right? They tripled their investment. And I think they were getting a new machine, it says up here. Okay, I don't know what I don't know what they invested in, just additional assets. All right, would you say let's not worry about the residual income just yet, but looking at the change in operating income percentage, and ROI, was that a good decision to invest that extra $3,000?
No,
Okay, I'm hearing some no. And why not?
you didn't get much back from the investment.
Okay, so the ROI went down, right? We went from getting 64% return on our investment to only 37% return. That's not good. On the other hand, our operating income percentage went up and our operating income went up. So you could see, some pluses and some minuses there. So was the decision to invest additional assets in the company successful? Maybe we could say not that much. Explain. Although the operating income and percentage went up a bit, the ROI went way down. And then if we look at the residual income, it went up about $500. So if we add that into our calculation, then what do you think? Was it a good investment? Invest $3,000, the residual income goes up 500. It's not that great, right? So let's say for C, although the residual income went up, it was only by $500, which is not that impressive for a $3,000 investment. Now, there might be reasons that you would make this investment. Maybe it's part of the company's overall strategy. You know, not everything can be boiled down to just a couple ratios. But if that's all we have to look at, there might have been better opportunities, better ways to invest those extra resources, those extra assets that would have yielded better results. All right, questions or comments? All right, well then, we're 2/3 of the way through the chapter already. I told you it's a light chapter. Okay. I did mention that sometimes there are some uncontrollable costs that a manager might be held accountable for. Either they're just fixed costs or they've been allocated from a corporate office. For example, you have no control over the cost of electricity or the cost of gas, right? Maybe you can control how much your department uses those things to some degree, or where you get it from. You might have a little bit of wiggle room there. But in general, gas prices go up, electricity prices go up. That's kind of out of your hands, right? So those are some costs that are generally uncontrollable. Here's this term, somebody mentioned it earlier, goal congruence. The manager's goals should be aligned or congruent with the goals of the company. Everything that is being done should support the company's mission, vision, strategy. So if you've got managers trying to do something that does not support the overall company goals, well, that's a problem. They're actually working against the company instead of supporting the company, right? So whoever's setting the goals for the managers wants to do so carefully. If you tell your managers, let's use Wells Fargo as an example. You might know about the big scandal that they had where there was so much pressure to open up new accounts that the employees were opening up accounts fraudulently because they felt like they would lose their jobs, and they justified it in their own minds, even though there really is no justification for committing fraud. But it's because the goals that were given to them, open up this impossible number of accounts, was not really congruent with the long-term benefit of the company, right? I mean, maybe they thought as a company that they'd get away with it, but they should have known. Eventually, the customer, well, if you put so much pressure on your employees that it causes them to do illegal things, eventually that's going to come back and hurt the company, right? The customers who had accounts opened without their permission are going to complain. maybe notify the authorities, and it's gonna become a big thing, and that's what happened. So whatever goals you're setting for your managers should be things you really want them to do, because it supports the long-term objectives of the company. And that's what goal congruence is. Oh, okay, so this is an interesting example of thinking about costs. Used to be, back in the day, that if you had a car, you were supposed to change your oil every 3,000 miles or 3 months. And then it started to be like, oh, you could go 5,000 miles, especially if you use the synthetic oil, or then it was like, oh, maybe you can push it up to 10,000. Now your car, if it's a newer car, just tells you when you change the oil. Unless it's an electric car, then you don't have to change oil, which is nice. But the way cars are designed keeps getting better and better. They don't need as much maintenance as they used to. Now, God forbid your computer goes out in your car, that could be a $5,000 cost right there, or somebody bumps your bumper and it's $1,000 to replace the bumper. But in terms of just maintaining the car with oil changes and, you know, filter changes and so forth, these days, you don't have to do it nearly as frequently as you used to. And the same could probably be applied at most companies, where the equipment that they're buying is built in a way where it doesn't need as much regular maintenance. So that might be a temptation to buy new equipment, right? Might save you money instead of having to continually maintain, especially if your equipment's breaking down, but even just the regular maintenance over time, it gets costly. However, if you're depreciating those old machines, you sell them, well, you're not taking that depreciation anymore, right? You might be able to depreciate your new machines. You also have the cost to pay for those new machines. So if you're a factory manager, this might be something you're thinking about. I can make it even more relevant. I'm sure there's some ERP system, some enterprise resource planning software program that's perfect for community college, would solve so many of our technical IT issues if we invested, I don't know, millions of dollars to buy that program. But it would be a huge investment, right? Where we have these other programs that maybe are already paid for or they're less expensive. So we've got this patchwork of different programs that we're trying to all, you know, knit together with like rubber band and bubble gum to get it to work together. And that's why when you go into Duo, you have 20 different programs instead of it all being connected under one. Right? So yeah, we could invest in a better system. Is it worth it? What would be the return on that investment? Considering the cost of capital to finance it. You probably don't have just a bunch of cash lying around to throw at the problem. The return, how much time is it going to save us? Is it going to allow us to enroll more students, bring in more revenue for the college? Right? These would be the factors we'd have to consider. And all these different ratios that we've been learning, ROI, residual income, profit margin percentage, are different ways to look at that and help make the decisions, just like we did in that problem. So as it says here, delaying replacing equipment keeps depreciation lower. Because we've got those old machines, we might have fully depreciated them already. Or, you know, if those machines were cheaper, or we've done like the double declining method, we probably have lower depreciation costs. And if we went out and bought new machines that are more expensive, and we're gonna have more depreciation expense. So if we're trying to make ourselves look more profitable, that's one consideration. Sticking with the old machines means we have a lower depreciation expense in most cases. On the other hand, newer equipment will allow us to be more productive. Maybe our products will be higher quality. Maybe we won't have as much labor costs, right? So there's a lot to consider. Now add to that situations where you've got departments that sell their product within the company to another department. You remember process costing. We learned about how every department adds their own material, their own labor, their own overhead. And then once they complete their job with those units, they transfer them out to another department. Remember that? And those costs get transferred. So it's kind of like they're selling those units to another department. But sometimes when companies do that, it's not just the actual cost. Sometimes a department might add a little bit of profit and actually make a profit off of selling to another department in the same company. Or they could be selling at a loss in some cases. So this is called transfer pricing. And the reason that it becomes important in some companies is, again, every manager is held responsible for their own costs and their own revenues, depending on what type of discretionary center they're in, or responsibility center. So if I'm making some products in my department that I can sell to the public, but I could also sell it within the company, how do I set the price? Do I charge the other departments in the company the same thing I charge the public? Do I give them a break because they're part of the same company? Well, that's going to cut into my profits. So there's no right or wrong answer here, but it is something companies need to decide. So here's an example of a transfer price. We've got two departments making, I think, soda, yeah, soft drinks. And so there's a blending department where they blend the ingredients together. And then there's a bottling department that puts the drink into the bottle. And everything that the blending department, well, not everything, most of what the blending department makes, it's selling to the bottling department. A little bit is being sold externally. So $75,000 from the blending department gets transferred over and sold to the bottling department. And then they put it in bottles and then they sell the completed product. Now, is that a fair price? Who knows, right? It kind of depends on who you ask, right? I'm sure the blending department would like to charge more, and the bottling department would like to pay less, right? So when you have this transfer pricing, you always have this potential for conflict between the departments. So these are the different methods you can use for setting your transfer price. You could base it on the market price. Whatever you sell it to external customers, or whatever external customers are paying for it, even if they're buying it from somebody else, that's the price that you charge internally. On the other hand, the lowest possible price you could go with would just be your variable costs. So if the blending department is charging the same price per unit that they sell to the public, that's market price. That would be the highest price. If they're only charging their variable costs, they're not even trying to cover fixed costs, that would be the lowest possible price that they could charge. Then we've got a couple options. Oh, the full cost, that would be the variable plus the fixed. Now you're covering your costs, but not making any profit. you wanted to add a markup, in other words, a little bit of profit, you could do the variable cost plus a markup. In fact, you might have heard of the store Cost Plus. Imagine that's where they got their name from. Or you could go full cost, the variable and the fixed costs plus a little markup. So those are the 5 options for transfer pricing, and the range would be anywhere, like I said, between the market, which would be the highest, and variable cost only, cost-based price, which would be the lowest. That would be the range. So here's a scenario, okay, and let's see what our options are here. We've got 2 divisions. The box division buys these displays from an external company for $12.50 per unit. That's the market price, right? However, in the same company is this paper division. They've got excess capacity. They could make units for the box division without giving up any other sales. If they're already at capacity, if they're producing as much as they can, that's a different story. But in this case, they've got the capacity and they could make the extra boxes or extra displays for the box division. So the question arises, what price should they charge? If they do the market price, well, the box division's not really gaining anything, right? Because they could order from outside the company at the market price and maybe get a superior product. Who knows? On the other hand, if the paper division charges the variable cost per unit, they're not making any profit. That works out great for the division that's buying. They're saving $4.50 per unit. But the paper division, they're not gaining anything. Again, they could add in the fixed cost. That would bring it up to $9 a unit if you add $1 in fixed costs. Again, they're still not really making a profit. They're just hoping to cover their own fixed costs. Go with $12. That's a little bit under the market price. So the buying division would be benefiting, and the selling division would be benefiting as well. So where do you set that price, right? That's the question. So these would be the options. If you crunch the numbers, the range is anywhere between $8 and really could have gone up to $12.50. What's the right range? You know, generally you'd say probably somewhere in the middle, right? So that both parties benefit. There's basically a range of $4.50 of profit that somebody's going to get, or it's going to be split between them. If they go with the variable cost, then they're selling it for $8, whereas the box division was paying $12.50 before. So the box division's getting that total $4.50 profit. On the other hand, what if they went with the market price? Well, $12, that was the price they were selling to other customers too, a little bit under the market price, really. But in that case, the paper division's making the majority of the profit, $4 per unit. And then with these other options, it's somewhere in between, right? The profit, that $4.50 of potential profit, is split more evenly between the 2 different departments. So here we've got a situation, you're the president of the company, okay? And the divisions are complaining that transfer prices are too high. They've significantly increased. So you can understand why they're not happy. If their fellow departments are charging them more money, that eats into their profits. maybe eats into their bonuses, right? Because a lot of times a manager's bonus is based on their profits. So a cost accountant suggests you could use an outside supplier. That's an option. Think about that though. If instead of the departments buying from within the company, to save money, they start buying from an outside company. What are the pros and cons? Alexandra seems to say not a good idea. Well, what are your thoughts?
Maybe the other department could get like upset with that.
Okay, the internal department is going to lose sales, right? The one that was selling internally now won't have those sales anymore. They might not be happy about that. Very true. What are some other considerations? Using an outside supplier. Give up some control, right? What are some things you might be losing by doing that? Quality, right? Now, maybe you find an outside supplier that does a better quality job than your internal department. But how do you control it and make sure it keeps happening? How do you make sure that they deliver on time? Because they're doing it off someplace else, right? They might tell you, oh yeah, it'll be delivered tomorrow, and it doesn't show up. Out of your control. What if they later change their prices? Now you want to go back to making it in-house, but it's too late. You already lost those employees. So there are a lot of strategic considerations, right? There are some benefits to doing things in-house. Any profit that is made by doing it in-house stays in-house. Or if you've got a supplier making a profit, well, they keep that profit. So there are definitely benefits, when possible, to doing things internally. Now you can't do everything, right? No company can excel at everything that it wants to do. So sometimes you do have to outsource and you do have to rely on suppliers. What's the right solution here? I would say, well, we don't have enough information, but I would say, let's talk to that internal department that's raising prices and say, what's going on here? What can we do to get your costs down? So you can charge a lower price and you'll still make a profit, and then everybody benefits, right? It might require a little bit of investigation into the source of the increased price. Right. Questions or comments? All right. Oh, gosh. It's good that actually we are at the end of the chapter because, like I said, this exercise and problem set are going to be somewhat time consuming. So I'm sure we're not going to finish them today, but we will need the time on Thursday to make sure we don't have to rush through it. So let's look at what we've learned. Again, companies need management control systems to make sure management stays in control and is meeting the profit, cost, revenue, and investment expectations. Some companies are more centralized. They keep more control within a small group of executives or departments. Others are more decentralized. They allow people at lower levels of the organization or away from the corporate offices to have more power and decision making. Either way, you need to know who's accountable for what, right? So we have different types of responsibility centers, and we call it responsibility accounting, so that we know what to hold different groups responsible for. Are they responsible for profits, revenues, costs, only their discretionary costs and not their allocated costs, or are they also responsible for their investments? Some ways we measure is return on investment, residual income. And not really complicated calculations. Basically, your return divided by your investment. And it's your income minus your investment times your cost of capital. Right? And then we've got transfer pricing. How sometimes departments sell to other departments within the organization. And so then you have to have a fair price, right? Something that everybody's happy with. All right, so that's our chapter. We actually have a few minutes, so we might be able to knock out an exercise or two before we even get to our break. So let's do that.